the Fed pivot. On September 18th, Wednesday, the Federal Reserve cut rates by 50 basis points after hiking rates throughout 2022 and holding those through much of 2023 and 2024. And so today we're going to talk about the first Fed rate cut since 2019, actually. So that's what's on the docket today. I'm your host, Jonathan Bednar. This is the What the Wealth podcast, where we talk all things retirement, investing, financial planning for you so that you can make informed financial decisions about money, about life, about retirement. This has been really an interesting rate cycle. We had inflation hit, as we've talked about many times on this podcast, as high as 9%. Today, inflation is sitting somewhere around 3%. I don't have that CPI inflation number in front of me right now, but it doesn't much matter what the actual number is today. What's important is the inflation rate has come down because of the Federal Reserve raising interest rates to where they did, around 5%, and keeping them there while the inflation rate has come down. Now, I'm not going to try to sugarcoat or make some fairy tale up that inflation is really down. Of course, eggs are more expensive than they were 4 years ago, as is gas, as is almost anything that we buy, whether it's goods or services. And that is really the nature of inflation in and of itself. Every year, there's a cost of goods sold or services sold that increases year over year over year. I actually just put in a 1950s Coke machine, Vindo 56. These machines were built between 1957 and 1959. And I put this Coke machine in my Chattanooga office. We just opened it. And what's really interesting about these Coke machines is that for 10 cents, you could get a fresh glass bottled Coca-Cola beverage. Those days are long gone. So today, a Coke costs you, around $2, $2.50. Gone are the days when you could get a 10-cent Coke, except for at Paradigm Wealth Partners Chattanooga office. We still offer them. The history of that kind of 50, 60 years where a Coke's gone from 10 cents to $2.50 or $3 is really the same thing we see across everything, all goods and services. And that will continue to happen. In 20 more years, Cokes aren't going to be $2.50 or $3. Cokes are going to be $4 or $5 or $6. And so while the inflation rate, and really we're talking about the rate of change. When a couple of years ago, the inflation rate was 9%, that was the rate of change from the prior year. Today it is 3% or plus or minus, and that is a 3% rate of change above the previous year. And so the idea that inflation is down is true. The rate of change is down from where it was last year. That doesn't mean that inflation is still not higher than it was from several years ago. And so I think there's a misconception there. But what the Fed has done is what they tried to do by keep rates high to allow higher rates to take some of the money supply out of the market, which would then slow that rate of change down in the inflation rate. That has happened. So it's come to a point now where it made sense for the Fed to cut interest rates. We were at around 5%, now we're 50 basis points or 0.5% less than that, which is actually a positive for the market. We actually saw on the 18th, when the Fed cut these rates, not really know how to act. The market went up, then it went down, then it went up, and it kind of bounced all over the place. On a Thursday, the 19th, the market had a great day. The market rallied pretty strong and kind of rejoiced the Fed taking this decisive action to cut rates by 0.5% instead of 0.25%. And that really showed their commitment to the time has come. There has also been some kind of sluggish numbers in the jobs reporting that's happened lately that's made it seem like maybe we don't have as strong as economy as we thought we did, and maybe the Fed missed their chance back in July. I do think looking back, they should have taken that chance to cut in July and they didn't. And so the market has rebounded some, kind of gave them another, if you will, kind of a T-ball at bat to cut rates. And so they didn't miss that chance now. The forecast is they're going to cut rates again by probably another, well, there's several forecasts out there. I've seen 120 basis points total, which would be 1.2%. I've seen potential another 50 basis points in November and then multiple cuts next year. The point is, I think the target, the market's kind of forecasting a target Fed funds rate of about 2.9% last I saw in 2026. So we're going to be slow, but they are going to be methodical. They're not going to just cut to zero unless really the bottom falls out of the labor market. We see maybe a recession start. I actually don't think data supports that we're going to have a recession right now. That could obviously change. And a lot of times we don't even know we're in a recession until when the recession is actually called, which is actually 2 quarters of negative GDP. So just because the market goes down doesn't mean we have a recession. It means that we've got some volatility in the market. If we have 2 negative quarters of GDP, that means we have a recession. So if we have a recession or again, job layoffs, we have high unemployment, something like that, then I could see the Fed cutting rates substantially, maybe back to zero. But I think we're far gone from that zero rate policy. I think we're going to try to set a new normal of somewhere around 3% Fed funds rate. This is actually positive for the market. That means it's going to be housing, mortgages are going to be cheaper. Car loans are going to be cheaper. It's going to be cheaper for businesses to get loans to continue to support and grow in the local community, servicing good services for consumers. So this is actually a net positive for people. They win, the communities win. It won't be an instant effect. It will be a slow, methodical kind of trickle in. It takes a little while for these to be felt. There's one downfall, is that we've gotten used to 5% interest rates in money markets accounts and kind of high yield savings. And it's been easy to just kind of park cash and it earn a decent return for the first time in 15 years. Those days are coming to an end. I don't think it's going back to zero, but I do think it's going to start to start dropping, and they will drop rather quickly as the Fed cuts rates. So I'm going to share a tweet from Ryan Dietrich, who is the chief market strategist at Carson. He was a former chief market strategist at LPL Financial, one of the greatest financial statistical wizards of all time, in my opinion. That's not proclaimed. It's just, he's got a really great mind. So what he said is, and I'll show this if you're watching on YouTube or somewhere else in video format, the last 20 times the Fed cut rates when the S&P 500 was within 2% of an all-time high based on the day before the cut, which is what we just happened, meaning the Fed is within 2% of its all-time high. The last 20 times the Fed had cut rates, with that window, 2% of the S&P 500 in an all-time high, the S&P 500 was higher a year later all 20 times and up 13.9% on average. Yesterday was the 21st time. That doesn't mean that, we're going to be 21 out of 21. We could not be up next year or 12 months from now. But history as a guide shows us that the market likes when the Fed cuts rates. It makes it easier for people to get loans, to have cheaper mortgages. It's easier for businesses and for companies to refinance debt, to get new debt. And the market rewards the S&P 500, or the S&P 500 investors are rewarded with staying the course and not getting sucked into kind of the panic and hysteria of what's going on. So I thought that was a really interesting stat for you to kind of think about and ponder. I believe that this is beneficial for the market. I think the market continues to go higher. We're going to have volatility. That's natural when you're an investor. It is important to stay the course, be confident in your retirement. Cheers to lower rates. Have a wonderful day. Thanks for listening. If you haven't already subscribed, please subscribe.